Thank you everyone for joining us today. We want to let folks complete their login to our webinar, and then we will go ahead and get started. All right, thank you everyone for joining us. As we continue to have folks join the webinar, we'll go ahead and get started. My name is Katie Bays. I'll be moderating today's webinar, which is on what to expect in your first transferable tax credit transaction, hosted by us, the team over here at Crux. I want to introduce our four distinguished panelists who will be joining us today for a discussion of navigating the first transaction and transactions in transferable tax credits. Today, we are joined by Sam Kamyans of Kirkland and Ellis. Sam is a partner in Kirkland's tax practice group. He's an experienced advisor in partnership taxation and has advised on tax-driven transactions throughout the energy complex, including carbon capture, hydrogen, clean fuels, solar storage, and other energy transition projects. We're also delighted to have Julian Kilcullen from Invenergy with us today. Julian is the Vice President of Mergers and Acquisitions with Invenergy. And Julian and his team recently announced the largest and really the first major public deal in transferable tax credits, a $580 million sale of production tax credits to Bank of America. We're very happy to have Julian with us today to share some lessons from that important transaction. We've also got Corey Lewis from Aon. Corey is Managing Director in the Transaction Solutions Group. Corey co-heads Aon's North America tax insurance business and leads the tax credit insurance practice. Corey is here to talk to us today about tax credit insurance. And then, of course, we've got Crux CEO Alfred Johnson. Alfred, you give your bio better than just about anybody, but having heard it a couple of times, I'll do my best. Alfred founded Crux with our co-founder and COO Alan Kramer, with the mission of making sustainable finance more efficient and transparent and interconnected. Alfred's career has included a couple of stints with the U.S. Treasury Department, including most recently as Deputy Chief of Staff to Secretary Janet Yellen, and at BlackRock in their structured finance group. Thank you all so much, our speakers, for taking the time, and thank you so much to everyone who has joined us on the line today. Now, I want to say we welcome questions from our audience. Folks are welcome to submit questions via the chat feature, and we'll get to them as quickly as we can and answer as many as we can. Our colleague Jess is going to be moderating the questions that come in through the line. We're going to begin our webinar with a round robin style discussion today. Jess, I'm going to ask you to go ahead and end the screen share so that we can see our panelists' faces and we can kind of go ahead and get into some of the questions. As the webinar indicates, we're going to be talking about what you should expect in the first transaction transferable tax credits. So we've kind of inartfully divided a transaction into four big stages or phases. First, it's the decision, the awareness of the market, the decision to participate in the market for TTCs or transferable tax credits. Second is price discovery negotiation, then due diligence, and then closing. So I'll ask each one of our panelists a question, and we welcome answers from all four of you on each one of these phases, these major phases. But to kick us off, Sam, would you please set the stage for us a little bit? Talk about the state of the market for TTCs as you see it today and some insights into how folks are approaching this market and approaching their first transactions.
Yeah, yeah, happy to. Thank you. And thanks, Alfred and the Crux team for setting all this up. It's really important work, and we're getting this market built up, and it's going in a great direction. I think in terms of kind of what we're seeing right now and how the market's developing, I am really excited that it took off as quickly as it did. And what I mean by that is market participants were interested in transferability the minute the IRA passed. And the fact that deals have been executed, as the Invenergy deal illustrates, and that there's so many more deals in the pipeline really speaks to the necessity of having the transferability market established. And we applaud Congress and Treasury for putting out rules so as quickly as they did. In terms of kind of what we're seeing and how the market's developing, it's really interesting. Both sides of the poll are developing at a rapid clip. And what I mean by that is not everyone has $580 million of tax credits to sell. Most of the developers that we see have quite a bit less, but they're both approaching these deals with an open mind, and everyone is really focused on, okay, we know how tax equity works. This is intended to be simpler, so let's go back to the drawing board and style these deals in a manner that can considerably simplify the process. And that really is bearing fruit in a considerable way. One thing that I hadn't expected, but now makes a lot of sense, is that these deals are very similar to your M&A transactions. So if you take a step back, somebody has goods to sell, somebody has money to buy those goods, and really what's left in the middle is how much are we going to pay for those goods, and how do we ensure that those goods are as they're warranted to be. And so from that lens, it really kind of steps its way into the M&A world with a far more limited scope of diligence that has to be done. The buyer is not going to be involved in the seller's business in any way whatsoever. They don't need ongoing financials. If it's a production tax credit, you get quarterly updates as to how much is being produced and ensuring that the project is going based on schedule and determining how much money should be injected into the system. But really beyond that, we've pulled back so many layers from a tax equity deal to the point where we can see several years down the line this being a highly commoditized market that can be fully accelerated and enabled by a tech platform that standardizes the transactions and puts buyers and sellers, and they really just focus on what the commercial terms ought to be. And I think that's across the board from the large transactions to the smaller ones. We still see insurance policies wrapping some of the risks in these deals. My personal take on that, we'll see how the market develops, is this is still fairly new, so people need to be treading very cautiously, and as more risks are resolved and identified, I can see that market evolving. But that's kind of my 2 cents in terms of how the market has surprised me. It's really been the rapid growth and how quickly we are getting to an understanding of how these deals can be put together in a simple way to administer, particularly through a centralized platform.
Yeah, just to layer into that, I agree with everything that Sam just said. Dynamically, it has been interesting to watch supply and demand develop at slightly different cadences. I agree we've gotten to the point where both are very actively interested in meeting each other. For the first half of this year, in the pre-guidance period, we had a lot of supply queuing in the market, developers looking to sell. Obviously, that makes sense. I'd say what we have observed since the guidance came out June 14th, and especially subsequent to the announcement of the Invenergy deal, is there's just a lot more attention on this market from the buy side. And many buyers are getting the benefit of advisory from tax advisors, their banks, syndicators they may be talking to, who are helping to pull them into deals. So now there's quite a lot of bilateral interest on the sell and the buy side for 23 and 24. So in that sense, like completely agree with where we are landing there, Sam, and it's been exciting to see that develop so quickly.
Yeah, and I just want to say, I think, Sam, your observation that the market is on track to becoming commoditized is a very exciting and bold prediction. And I think it would be interesting to hear, from your perspective, Corey or Julian, what you kind of see in that front. What do you think are the obstacles to greater efficiency or commoditization, or what do you think is kind of what do you think of that process and that opportunity?
So I think, at least from an insurance perspective, it's definitely possible. But I think every deal, at least so far, has been sort of on a deal-by-deal commercial negotiation basis between the buyer and the seller. One of the good things with tax insurance, and for those of you who may be unaware, with tax insurance, we insure known identifiable tax issues or tax risks, and are extremely active in the tax credit space, specifically insuring ITCs and PTCs, whether they'll qualify for the credit, for ITCs, whether they'll be recapture or clawback on the credit. There's a lot of flexibility in terms of what that insurance policy can insure. So it can insure one tax risk, it can insure 10 different tax risks, it can be used to act as a credit enhancement to an indemnity or guarantee from the seller of the credit, or it could theoretically be used in lieu of an indemnity or guarantee. So while all of those are good things to have that ability to mix and match and to be used in different ways, in theory, maybe a year from now, we've settled on here as the norm from a tax insurance perspective, and in every transaction, we're going to insure these 5 things, and it's all going to be single trigger where it's not necessarily meant to credit enhance an indemnity or guarantee. But right now, I'm not exactly sure where that's going to shake out. So at least in these early days, where it's kind of the wild, wild west, so to speak, every deal, every transaction is different in terms of what specific risk or risks folks are concerned about. But I definitely could see things changing, in the very near future as we start to ramp up and see more and more moving forward.
That's great. Thank you. And Sam, if I could kick one more question to you before we move on to the next next phase of the transaction, if you will, the next part of our discussion. We have been internally discussing at Crux, I think, some of the opportunities or the obstacles to taking advantage of these tax credits based upon when the underlying project goes into service. And this is, of course, new and complicated, but we know that there's a real demand rush for 2023 tax credits and a limited supply of those tax credits. But what does that mean for projects which might have their commercial delivery slipping into the first quarter of next year, or early 2024 in service date? Are buyers able to purchase and potentially use those credits to address their 23 tax liabilities, or how could you maybe comment a little bit on how you see that process working?
Yeah, happy to. I think I think this is kind of an evolution of what we've seen in tax equity deals in the past. So there's no shortage of deals that have slipped from Q4 of the year to the following year. And so I think the way the dynamic will shake down is, listen, everybody wants it to be for 23. The project ends up going online in 24. So the basic end game there is the credit is usable, right? Whether you use it in 24 or 23 really depends on, did you have sufficient tax liability in 24? Do you not? And that really becomes a waiting game of, you have to wait until the end of the year to know what your total overall tax liability was, to evaluate what year it's going to go into. So I think from the buyer's perspective, they can go ahead and, as much as they wanted the 23, the project slipped. Commercially, you can handle any time value of money considerations. And then from there, really all that's left is apply it against your Q1 estimated tax payments. If there just wasn't enough tax liability in 24, there are carryback provisions to push it back into 23, which provides some administrative complexity. But I think all that is to say, the value is not entirely lost. It just shifts the value from one year to another. So the time value of money considerations are going to be paramount in those deals. And it's a familiar dynamic we've seen in tax equity, which is almost always resolved with some commercial agreement among the parties as to when they take the credit.
Thank you. That's helpful. And it does sound a little bit like maybe folks shouldn't be going to a remote cabin in the woods over Christmas where they don't have cell service. It sounds like there can still be some dramatic end of the year work that has to be done just to make sure that projects are able to deliver the tax credits that buyers are looking for. Do you think that's right, or do you think that our end of year might get a little bit more laid back?
Yeah, I think we've seen this. We've seen this dynamic before. People are going to rush to get their projects online in time, and I think that'll continue to happen. we see it at the end of every quarter, but yeah, and end of year is even more important now. Good luck getting your utility to do the witness test on December 25th, but we can cross that bridge when we get to it.
Right. Well, that's great. Thank you. That was a subject of some debate amongst our team, so it helps us certainly, and I think it probably helps a lot of other folks on the line. So, Julian, without further ado, I want to turn to you and ask you to talk us a little bit through your price discovery process. How did you navigate that? And then even at a bigger level, I'd love to hear some of the lessons learned and takeaways from your recent transaction.
Sure. Going into this deal and our first negotiation with Bank of America, I think our only insight into where the market was thinking about this was the same source as everybody else, which is going to conferences and talking with counterparties. And my recollection of that period is that the market was coalescing around figures to the tune of 80 to 85% of value for tax credits. And we were very bullish on transferability leading up to the IRA and in anticipation of June's guidance. And we had a pretty strong conviction that was undervaluing the credit. And it wasn't a dramatic part of the deal, actually. We were pretty pleased to find that when we found a willing partner in Bank of America, that we were generally aligned on value, and that didn't end up being a material negotiation. And from what I'm gathering about other negotiations and transactions that are taking place now, I think that the market has shifted to kind of center around that same vicinity. So, I think we ended up in a good spot, and one that the market seems to agree is rational. It is the balance of the deal is I think where a lot of the interesting parts were. Obviously this was all done in the name of underwriting an acquisition of 14 operating projects, only a few of which are actually kicking off PTCs, but a very large amount. And the timing of all of this was kind of like immediately getting started, was immediately post IRA, but still several months in advance of June's guidance. So, the ability to not only find a willing partner that was taking the risk with us in advance of guidance, agreeing to a price that we also thought was rational, but then agreeing to get it done on a timeline that underwrote an acquisition and an associated financing was, that is kind of where I think the rubber really met the road. So, I would categorize a lot of the negotiation around two things. One is just, to a certain extent, doing a first deal and saying, okay, well, this falls somewhere between a PPA and a tax equity deal. What things should apply here and what things shouldn't. Ensuring that was, that we were agreeing to things that were not only workable for the sake of PTC transfer, but then our lenders as well. And then, they're not represented here today, but there was a massive undertaking on the part of our partners at Bank of America to underwrite a new product entirely, one that they were excited about and anticipated marketing at some point. But this was a first go for them too. So figuring out how this product fit within the bank, and capital treatment, security, accounting, and selling that to the organization was a very large undertaking on their part as well. And obviously that had implications that we had to accommodate in the name of getting the first deal done.
Thank you for that. And yeah, congratulations on that massive deal. And I'd also love to hear from the rest of our panelists. What do you think that that deal signifies for how the market for TTCs is taking shape? And we did get a question through the chat that I kind of want to incorporate into this because I think it's similar, which is, what else might be needed to really bring buyers, and especially new buyers, into the market. And I will not
I'm
comment.
happy to take that a little bit.
Thanks, Sam.
I really like that Julian characterized it as someplace between a PPA and a tax equity deal, and that's a dynamic that we hear described by lenders quite a bit. There's a lot of exuberance over the fact that you could lend against a party's sale of a stream of PTCs over a 10, 12-year period if you have a carbon deal, and they view it as just a much more predictable stream. I think there are some complexities that they'll have to work through in terms of how you size to the variability. But if you have a P99, and for folks in the audience, we're looking at kind of the worst case scenario of production that a lender can lend against in terms of selling the credits, it makes it for a much more simplified instrument for people to finance against. And so that's been an interesting development. Another one that I certainly didn't see coming down, that people are going to look at this kind of new tax equity financing as similar to an offtake agreement or a PPA that fits within, from a lender's perspective, a wider swath of what their lending standards are able to accommodate. So that's been interesting, and glad to see other folks are kind of viewing it as akin to instruments, PPAs and offtake agreements that we've seen in the past.
The one thing I'll add, just in terms of, what do we think we'll need or see to bring new participants to the marketplace? I mean, what's been interesting has just been kind of the breadth of companies that I've been talking to who have an interest in potentially purchasing tax credits. I think there's, of course, a hesitancy, wanting to be a little bit conservative, not necessarily wanting to be the first people to kind of dive into the pool, so to speak. But it's been, amusement park companies or guitar companies or small privately held plastics manufacturings. I mean, it's really the key game changer, of course, with transferability is that now any, corporate tax paying entity, it makes economic sense to go buy tax credits, right, rather than pay 100 cents on the dollar in terms of taxes. So I think it's going to be, of course, opening up the market of who will be buying these tax credits much more broader than the current tax equity investment marketplace.
I totally agree with all of that. And Corey would echo what you're seeing on the demand side. As everybody on this call probably knows, there are very few current participants in the tax equity market. We are seeing much more breadth of interest for transferable credits than was ever observed in tax equity syndication. I also think Julian's deal is important from another perspective. So it was announced on the roughly 1 year anniversary of the IRA. In the early takes on transferability versus tax equity, the wide perception was that deals of that size would go the tax equity route exclusively and not via transferability. And it's interesting to see a deal of that size be the first one that is, largely announced and marketed in the market here. And I think what that suggests is there's a lot of fit for transferability across a wider set of developers than was initially anticipated. So it's everything from utility scale, ITC and PTC, all the way down to novel technologies, smaller deals, things like that. Obviously, the insurance and other dynamics are different at the small end of the market versus the large end of the market. But I think that given the amount of attention that Julian's deal got, that has also helped to create more supply and demand interest in the market than was there before that deal was announced. I think it was important to the development of the market.
Right. And, and we have a question, Julian, that's come in related to if you could kind of go into a little bit more detail around the underwriting. But I think that, Alfred, the observation you just made about the deal illustrating sort of the flexibility and the applicability of transferability, even in these very large transactions, Julian, I don't know if you're comfortable, but I would love to hear any other color from you on kind of what transferability enables or enabled you all to do, which perhaps, before that provision was made into law, you might not have been able to, in the context of the transaction and underwriting.
Yeah. I mean, it was a pretty compressed transaction timeline as it was. And the finalizing the tax credit transfer agreement did take most of the time from signing to closing. Could we have done it in less time? I don't know, maybe. You always tend to like go until you're your outer limit. And certainly, part of the complication was negotiating a new product, but the lack of an upfront capital commitment, which is not entirely true, because obviously the bank in this case is making an internal capital commitment, but the not having equity risk in the projects, I think really uncomplicates the diligence, and then also just all the hooks that a tax equity provider puts into the deal. So, thinking about negotiating a full tax equity agreement for, a PTC check of that size, and then layering debt on top of that, I'm not sure that we would have actually gotten all that done. I would like to think so, but I think that there is just there's an intangible element of freedom from a transferability deal, and simplification that is hard to quantify and doesn't necessarily show up in IRR, but is still really valuable nonetheless.
I think that's a really fascinating observation, and I think that if we have a tagline from the webinar, that might be it. Just this intangible value of the freedom of transferability is really very interesting observation. And you brought up diligence as well, which is kind of the next phase of a transaction that we wanted to talk about. So that's, to you, Corey, obviously obtaining insurance continues to be critical for tax credit deals, and especially for investment tax credits, but I think for any of the above. So how can you describe a little bit of, differences you might see or might not see for a TTC deal versus tax equity deal as it pertains to the diligence process?
Yeah, definitely. So Sam and Julian both kind of hinted at how the diligence process when it comes to transferability may be a little bit neater or easier than what they're maybe used to from a tax equity investment construct. With respect to tax insurance, and in terms of what the tax insurers are going to need from an underwriting perspective, the diligence isn't necessarily really materially changing. And the reason for that is most, if not all, of the risks that we're being asked to insure from a transferability context are very much the same or similar to the risks that we insured from a tax equity investment construct. In big picture, the tax insurers aren't going to take on any risk that they think is ultimately a loser if it gets challenged. They're going to take on risks that they think, if the tax authority challenges, that they will successfully win when discussing this with the tax authority or potentially taking it to the courts. So if we are ensuring that the qualified basis or fair market value or step up will be respected in an ITC transaction, we would still expect to see a third-party appraisal and a cost segregation report from those independent third parties. If we're ensuring something that's a legal conclusion in nature, whether that's maybe potentially the energy community adder being respected as an example, we would anticipate or expect to see a tax memo or tax opinion. So the diligence, or I should say the underwriting from the tax insurer's perspective, isn't necessarily materially changing. But I think the broader benefit is on sort of the deal itself between the buyer and the seller, that's able to be streamlined and to move a little bit quicker. And with tax insurance moving as quick as it does just in its normal course of business, no issues or concerns there.
That's great. And I mean, I think, to you, Sam, and to you, Julian, I'd also love to hear, how whether or not or how you see differences on diligence, Sam, and then Julian, maybe if you wouldn't mind commenting a little bit on insurance and what you observed in the course of your transaction as well.
Yeah, happy to. And I like the way Corey kind of frames it as how the insurance market views it the same before and after in terms of transferability. Because the insurance market is focused on the asset itself, the recapture risk, and some of the just very like operational asset level focused items. And I think in a transferability deal, the diligence is simplified on the buy side because now they're less focused on we need to negotiate all of our governance and make sure we have a good counterparty. We need to focus less on the financials of the sponsor that's underwriting the partnership that we're into. So there's less focus for ongoing financials, particularly in an ITC deal. There's just a lot less focus on everything other than does this asset exist? Does it work properly? And do we trust the sponsor to continue operating it in order to avoid recapture? So from that sense, it's almost playing out in an ITC deal that the buyer is focused on the asset the same way that the insurance markets are. And it makes a lot of sense because now we've really narrowed the risk down to operations and recapture, the big ones. I mean, there's still a lot more out there in terms of what people have to rely on, but it's just markedly different than negotiating, being a partner with somebody in a deal, which in turn is going to reduce that diligence load and enable just a much quicker approach towards a streamlined process.
Thank you, Sam. And yeah, I mean, Julian, if you wanted to comment at all on the what you observed for insurance in the course of your deal, I think it'd be a very interesting real world example.
Yeah. I mean, really not a lot to add to what Sam just said. It was and is, I don't want to underplay it, but it was not a material pain point in the transaction. For a PTC deal like the one that we did, your qualification fact pattern needs to be tight, and if you have that well documented, there's really not a lot to be too concerned about beyond just kind of like the normal grind of getting through the PTC underwriting process. And so, I guess I don't have a ton more to say about it than what's already been said. Working with Bank of America, it's also, as Sam said, where it's like they're focused on the same thing. So, they need to be comfortable with the production profile of the projects, so that when they're thinking about internal capital allocation in the case of a bank or potentially something else if it's a different type of buyer, that you're at least aligned on kind of like what your P50, P99 should be and what you're going to do with the excess in the event that you overperform, and that they're buying PTCs from qualified projects. But that really encapsulates it.
Mm-hmm. Yeah.
The one thing the one thing I just want to add, so Sam had kind of mentioned whether the buyers are going to focus, too intently maybe on the sponsor's financials and transferability. Maybe they're not focusing on it as much as they necessarily would. And one thing Alfred had mentioned, whether we're dealing with new technologies or maybe smaller developers that aren't found to be particularly creditworthy from the buyer's perspective, that's where I think tax insurance is going to play a huge role in kind of helping folks make that jump to make that purchase, because rather than having to do maybe necessarily a complicated credit analysis of that party who's providing that indemnity or guarantee, you can backstop it with an insurance policy that's an A- rated or better paper, and thus you can just look at that in terms of determining, okay, what's the likelihood that there's going to be another party who will make me whole if the tax authority comes in and disagrees with whether this project qualified for the credit.
That's really excellent color, Corey. Thank you. And Alfred, I just wanted to put to you, maybe this is one of the questions that's come in via chat and kind of moves us closer to the next phase of the transaction. But before we go to the discussion around closing, we've got a question with that when structuring these agreements, kind of setting aside some of the risks that we've just talked about for the last few minutes, some of the maybe low probability, high impact risks, or even just the risks, the newness risks of the transferability provision. I would love to hear a little bit about, coming from your time at Treasury, as some of these provisions were being discussed and debated, how do you think the market is evolving in capturing or dealing with some of those more, I don't know if it's existential risk is the right word, but some of the less readily insurable risks?
Yeah, I mean, I think this market is developing in real time as new counterparties come to the market. There's an education curve that they need to come up. I think it is really important that we provide the venues together as an industry to help people participate in this market, because when we look at, frankly, the scale that this market is going to need to reach, Katie, by 2031, we give this stat a lot. The tax attributes that will need to be monetized are something in the neighborhood of $85 to $100 billion a year that will overwhelmingly go to the corporate tax base of the US. On the buy side, the CBO estimates that will be 520 some odd billion dollars in the same year. So roughly 15% of corporate taxes would need to go through the credits to clear the market. And that's going to require a lot more buyers. Those buyers are going to need to get comfortable with the risks in transactions. We find that Corey and others that are providing and enabling tax insurance there are a critical piece of the puzzle for ITCs. We're seeing it around insurance in basically all ITC deals that are currently being transacted. I think the market is going to progressively expand into newer technology types, different kinds of risks than are the ones that are more traditionally associated in tax equity, and that the market has a better sense of how to handle. And we may see some impact in pricing for those kinds of credits that have risks that are perceived to be larger than some others. But the good thing about the construction, or a good thing about the construction of transferability, is that the market can handle some of that uncertainty. So to the extent that there are credits that are preferred by investors and carry less perceived risk, like PTCs from Julian, those may trade at a premium to other credits in the market, but it doesn't mean that other credits in the market won't clear, especially with the assistance of tax insurance when relevant in an ITC context.
That's wonderful. Thank you. And let's get to our last phase of the transaction. We have tons of wonderful questions coming in through Q&A and really appreciate those. We'll touch on as many as we can, but Alfred, I wanted to send it over to you now to talk about the fun part, closing. So our team at Crux has several transactions that are in advanced stages of negotiation. As you just alluded to, they really run the gamut, size, buyers, different kinds of technology. So it's been a very cool process to see. But what are some of the big, surprises and key takeaways from watching those come together? Both, I think, as a person passionate about clean energy, but then also as a founder of Crux, and seeing how that feeds into how we build the Crux ecosystem.
Yeah, thanks, Kitty. So at the top, Sam mentioned how the market is developing. We definitely see that happening now that guidance has been released. We've got hundreds of millions of dollars of transactions that are in some stage of transacting. As Katie mentioned, the deals vary widely in size, counterparty type, technology type, and that's encouraging given the nascence of the market. It suggests that it will be broad-based and reasonably fragmented as a market. Over the last couple months, buyers have really started to wake up to the opportunity here. I mentioned that in many cases, they are assisted by intermediaries like tax advisors and financial institutions that are helping them get comfortable in this new market and access liquidity via the Crux network. We are live with intermediaries who currently represent billions of dollars of annual volume, and we're able to go live really quickly with new intermediaries. So we're seeing conversations accelerate there about using Crux in a white labeled context to make markets on transactions. And for developers, what that means is there's a lot of demand in this network and in this market right now, and we can get you live very quickly. So let us know if we can be helpful. We are actively helping developers post projects to the market, and then facilitating the network seeing those credits and being able to express interest and then go through a closing flow. Other observations that I would make about the market. So broadly, the market is concerned about the availability of tax equity in 24 and 25, given just how much supply is anticipated to come to market. I think there's an interesting additional thread that people are starting to get their head around related to Basel III endgame and the potential implications to the banks. So I think we're going to see some regulatory forces influence the participation in this market, and that story is just starting to be told. At the inception of the market, as I mentioned in the context of Julian's deal, the market overwhelmingly thought that transferability would be more relevant to the smallest deals, things like community, C&I, resi portfolios, things like that. We are seeing it more relevant in a broader set of use cases than that. Buyers are more broadly distributed by size and industry than initially expected, and many are coming to the market for different reasons. Some are just coming to the market because they see a good financial product and want to manage their effective tax rates. Some also see the sustainability benefits of the credits and the opportunity for the credits to generate a savings, and that savings to be further deployed into other sustainability initiatives of the company, including things like buying RECs. So I think there's interesting interplay with different sustainable products alongside the tax credits. And then lastly, on pricing, I know we've got some questions in the chat about this. We are continuing to see that PTCs are trading at a premium versus ITCs in the market. Now, insurance does help with that, but still seeing a dynamic there. Those are some of the things that we're currently seeing, Katie.
Thank you, Alfred. I wanted to send back to you just quickly because I think this is a really interesting one related to the bundling of RECs in a TTC transaction. Do you want to touch on that as well?
Yeah, just briefly, companies have made really large commitments here, right? So companies have net zero commitments. They're not always funded, right? And we hear a lot from chief sustainability officers that they look for different mechanisms to be able to meet the commitments that the company has made. The interesting thing, again, about transferable tax credits, they will trade at a discount. So buy $10 million worth of credits for $9 million, save $1 million. You can either put that back in your pocket and smooth the ETR, or you can deploy some of that into other sustainability initiatives of the company, including RECs. And we are seeing good interest for REC plus TTC deals, which is relevant both on the buy side on this call, but also on the sell side as developers are building projects that have those attributes.
That's great. Thank you. And Sam, could I maybe kick it over to you? We've also got a lot of great questions about step-up basis, and perhaps you could touch a little bit on how step-up basis is dealt with in the context of a TTC deal.
Yeah, it's a good question, and I mean we get it daily, and I think what the market is now moving towards is to get a step up in basis, you need a third party to come on, and I think initially people view this as more of a tax play than anything else. But as we see the market develop, it's really created this unique opportunity for more entrants to come in to the market that are looking to generation, fuels, carbon capture, hydrogen, what have you, for a return on their capital. So it enables them to invest in an asset that's going to give rise to an ITC. They can look to the cash flows of that project, and as part of that overall investment and how we structure it, we can structure the deal as a purchase of the asset from a development company. And so you have a JV partner that comes in, gets the asset to its full fair market value, and then that JV partner is acting like a true partner in a deal. They want to get some of the revenues from generation. They might be involved in the O&M in some sense. They might want to stay in the deal for 2 years. They might want to stay in the deal for 10 years. But it's now created this great dynamic where we see even more depth in the market, that there's more participants coming in with additional sources of capital to really help with that basis step up. And almost all of those deals, it's a basis step up with transferability. So these partners aren't coming in looking for tax credits. They really are focused on cash flows generated by both the credit sale and on the operations from the project. So it's been interesting how we've solved these problems and how we're seeing them come to market. And it really is developing a much broader ecosystem of capital that's going to be deployed in these deals. Yeah, we're seeing a lot of it, and I expect to see quite a bit more in the coming years.
Well, thank you, Sam. That's extremely well put. Well, in the interest of time, I wanted to thank everyone, all our distinguished panelists, for joining us today. And of course, thank you so much to everyone who joined to listen into this discussion. I do want to acknowledge we didn't get to every question. However, some of these questions, which are excellent, are also very complicated. And so I really want to encourage folks who might not have gotten as detailed of an answer as you're looking for on the webinar to reach out to folks like Sam and Corey, and of course to us at Crux to learn more about this market. There's a lot to discuss, much more than we could possibly cover in 45 minutes. And so I just want to thank you everyone again for joining. You can find us online at cruxclimate.com. Reach out to us there to learn more, and I'll say thank you again and let Alfred close it out if you'd like to do so.
Thank you, everybody, for joining, and especially Sam, Corey, and Julian for being a part of it. We will share a recording of this and also a summary by email. So thanks, everybody, for joining. See you all soon.